Advanced Financial Accounting Excel Practice Problem. In this presentation, we will work a practice problem in Excel related to translation, consolidated comprehensive income, and stockholders' equity. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area on the right-hand side, including our journal entries up top, some worksheets down below, and our trial balance worksheet, which we're going to use for our translation process. Let's go back to the left, see what we're going to do. We have the translation, journal entries, consolidated comprehensive income, and stockholders' equity. Going to be some of the things we will be working on. It's going to be great. On 11X1P, the parent company acquired all outstanding stock of S, which is going to be the subsidiary. S is a foreign company, a Norwegian company, and therefore their books will be in a foreign currency, and we're going to have to adjust for that within our consolidation process. The cost is going to be $155,000 in dollars. The net assets of the subsidiary is going to be in the foreign currency. Now note, when you're adjusting the currencies, we're basically just simply using the currency home up top and using the dollars for the currencies. And then if you want to adjust foreign currency, I would go to the more items here and then go to currency, and we're looking for the currency items here. And I'm going to use the 3-letter for most of the time for the currency to note that, which is kind of long, but it gives us a clear indication that this is going to be the difference between the two. So then we have the S book and fair values were about the same for all items except. So in other words, if we took a look at the assets and liabilities individually, they're the same except for the few items, one being the property, plant, and equipment, PP&E, which is going to be $20,000 higher in dollars here. Remaining useful life is going to be the 10 years. The remainder is going to go to a patent. So a patent is going to be an amortizable or intangible asset, which we're going to have to calculate that remainder to go to the patent. No goodwill then that we will be having here. Five years for the amortized item that we will be putting on the books. S uses FIFO inventory method. Beginning inventory was purchased on 12/31/X3. Ending inventory was purchased on 12/15/X4. Purchases in 2000X4 were 430,000 in foreign currencies for S. We're going to be doing this consolidation, by the way, for 2000X4. So we'll be doing the consolidation for 2000X4. The purchase took place at the beginning of the year. We'll be consolidating as of the end of the year, 12/31, or the year end, 12/31X4. And then on S purchased all of the property, plants, and equipment on July 1st, 2000X2. So the subsidiary purchased all the property, plants, and equipment then. Straight line depreciation is what we will be using. S sales and expenses incurred evenly, so we're going to assume an even incurrence of the subsidiary sales and expenses. On 7/1X4, dividends were declared. So dividends will then be declared. We need to know the date of that so we can know the exchange rate at the point in time that they were declared. P income from its operations are $255,000. This is the parent company. Stockholders' equity $3,600,000 and dividends $160,000. We have the important exchange rate dates here from the foreign currency compared to the dollars, one foreign currency compared to the dollars. The krone is the functional currency. I may not remember that every time. I might be calling it foreign currency a lot, but that's going to be the functional currency. So that means then the subsidiary, if we think of ourselves as the parent, which is the perspective I usually will talk about us in, the subsidiary then is going to be in krones, right? That's going to be the functional currency, so that we can then translate from the functional currency to the parent's currency, which is going to be the dollar. Make schedule to translate the trial balance, and then from krone to the US dollar. So that's what we'll do on the right-hand side. We're going to make our adjustment, basically. So here we have the trial balance, and we're going to adjust those from the foreign currency, which is it's currently in here, noted here, and then we're going to adjust it to the dollar. Now, in order to do that, we're going to have to use some different rates to do that as we go. So let's take a look at that first. So I'm going to go back and I'm going to hide some cells. I'm going to put my cursor on E. We're going to highlight over to J, or select over to J is probably more proper language. Let go and right-click on the selected area and hide it. And then let's compare these because I want to be able to know what the translation percent would be. And that's mainly going to be down here with these exchange rates down below. So note, as we're doing this, remember we're doing a translation process because it's in the foreign currency here and we're translating it then to the U.S. currency. So for the balance sheet items, the general rule is that we're going to use the exchange rate at the end of the time period. So at the end of the time period, because these are as of a point in time, cash is what it is as of December 31st. This is what people owe us as of December 31st. So we would typically use the ending point here. So I'm going to say, all right, this exchange rate then is going to be as of 12/31 x4. It's going to be that 0.21. So we'll pick up the 0.21 for that one. That's going to be the same. I'm going to use that exchange rate down for the asset accounts. And we might want to just basically highlight, or I'm going to do that a different way. It's obviously that doesn't work for the formula. Let's do it this way. I'm going to say this equals this, or we can use an absolute reference. And then I'm just going to copy that formula down, which will just equal the one above it. And we can do that. So the 0.21. So they're all from the same place. Now you could even go down, we're going down to the balance sheet items, which include the liabilities. So we'll go down to the liabilities items as well. And then we'll have to make some adjustments for the equity section. Now the other way we might do this, this might make it a little bit easier to see if you go to the worksheet, is to use an absolute reference. So I'm going to delete this. I'm going to do this a different way. If I delete this and we take that and I'm going to say F4, I'm selecting F4 on the keyboard, or put a $sign before the C and a $sign before the 39. We only need a mixed reference, but I'm going to use an absolute reference. And then I'm going to highlight that and now copy that down. And then we can trace each one of these back to the same original component, which is going to be that item on 12/31. Okay, so we might want to highlight these. I might make them a different color just to say, okay, these are all kind of coming from the same place, which is right there. Let's do that, make it yellow. And then the 0.18, so we're going to pick up then the 0.18 for the next two items. And so the 0.18 meaning we have the 1231 or 1230x3 and the 11x4. And these items up top, common stock and the retained earnings, this is basically the retained earnings before the income statement items are closed out into it, right? Because this is a trial balance and these income statement items will close out to it. So this is basically beginning retained earnings before we have the dividends closed out and the revenue closed out. And we're going to say there's no activity or sale of the common stock. So we're going to be picking up, I'm going to be picking up the 0.18. I'm going to pick it up on 11x4, the 0.18 there, and I'll pick up the same 0.18 here. So let's make that a different color. I'm going to make that, let's make it green or something. And then say we pick that up here. And so then we have the dividends. Now the dividends are a little bit tricky because we're going to use a different rate for the dividends because we know exactly when the dividends kind of happened. So we want to pick up the rate at the point in time that it happened, more like a historical rate on the dividends. So the dividends, we said, went out. What did we say on the dividends? On 7/1x4. So we're going to use that date for the dividends, that exchange rate date. So that's going to be 7/1. That's going to be the 0.19 that we're going to pick that one up. So that's going to be the 0.19. So we're picking that one up. Let's make that a different color. Make this colorful. We'll make this one a colorful one. So that'll be the 0.19. And then we've got the income statement, which is a time frame, has a beginning and an end. Therefore, using the end date doesn't make as much sense. So we should be using the average date, which we're going to say is the average of the period that we're covering, the year 2000x4, which we're going to use this average, which is the 0.1. So I'm going to say this is going to be equal to that 0.1 then, or I'm sorry, 0.2. And then I'm going to make that an absolute reference and copy that down to the income statement accounts by selecting it and saying F4 on the keyboard, or you can put a $sign before the C and the 40. And then we're going to just copy that down. I'll copy that down. So there that is. I'm going to make that a different color now. I'm going to make it a different color. We'll make it, I don't know, I'm running out of colors. Orange. Haven't used orange yet. Orange is a good one. We'll make that orange. So there's our different rates. Now, because we converted this with different rates, then obviously we're out of balance. Note if we use the same rate, just don't do this, but just if I like save this before I do it, and then if I use the same rates and I just copy that down, then we'll have something that's in balance. That would make sense. That would be nice. Can't we just use the same rate, you might say? Like what I would say normally. But then no, we can't do that because it's not quite proper, because it makes sense to use the end rate here And then the retained earnings is going to be weird because it has a beginning portion and then the net income, which is going to roll out into it. And then the dividends, it makes sense to use the rate when the dividend was used. And then the income statement, it makes sense to use the rate that's average instead of like the end of the time period. So, but then we use these different rates, and what happens, of course, we end up with something that's not in balance. And we're going to need an adjustment, which is going to be the 21,280, which I'm going to put into this account. I'm just going to put it in there as a plug, and then we'll take a look at some worksheets here, which is going to be the accumulated other comprehensive income translation adjustment of 21,280. It should be a negative 21,280. And that'll put us in balance. That's going to go into the accumulated other comprehensive income. So basically, we got the net income here, 24,400, and then the accumulated other comprehensive income for the translation adjustment. Okay, so now we're going to unhide some cells again. We're going to work out some tables, and we'll take a look at the parent company, how the parent company would do the fully adjusted equity method transactions related to the subsidiary here. So that's going to be great. So let's go ahead and unhide the cells again. I'm going to put my cursor on the column number C, or letter C, and then go over to K. So the C to the K, right click on their area and unhide. So we'll unhide that. All right. So now we're going to be doing our parent company fully adjusted equity method transactions to what they would do, and to record their interest in the subsidiary here. Let's make this a little smaller so we could see this maybe. That might make it a little easier. All right. So we're going to say this is for the parent company side. So this is the subsidiaries books, which now we translated now from the foreign currency to the currency that the parent company is going to be using on their books, which is the US dollar. So now we're thinking about the parent company, how they're going to account for their investment using the equity method fully adjusted in the subsidiary. So first, typically we would have the investment in S, just like we have seen in prior presentations, and that investment was in the dollars. So no problem there. We're just going to say, yeah, we invested $155,000 on the debit and the credit side. So the other side is going to be going to cash. Straightforward. Now, the next thing that typically happens is we have the dividends. So the dividends went from the subsidiary, as we can see here, to us. We're the parent. I always think of us as the parent. We're the parent company. the parent company, because we own 100%. So they all came to us. But they were given to us in possibly the 47,000 foreign currency. And we're going to record it now. We're going to translate it to the dollars. So we're going to translate that to the dollars here. And I'm actually going to record it in terms of cash rather than in terms, meaning for us, that would assume that if we got the foreign currency, then we converted it to basically actual dollars at that point in time. So I'm going to record the cash here. We might have a transaction gain or loss that would be a result from us getting foreign currency and then putting it on the books and then translating it or exchanging it at that point in time. If not, we would put the debit to foreign currency, which we would value using the same amount, and just instead of putting it to cash, which would indicate US dollars to the parent company, we put it into the foreign currency units. So I'm going to say, all right, then we'll pick up the amount, which is going to be the dividends in dollars, which we already exchanged using the dividend exchange rate at the date or the point in time that the dividends were exchanged or were given. And then the other side is going to go to the investment in S. That's going to be then the credit. Next, we typically have the income, the net income, which we could see down here was 122,000 in the foreign currency, which we have now adjusted to the 24,400. Notice that number is not including the accumulated other comprehensive income. So now we're going to say, and this is revenue, not a loss. Credits winning over here. So we're going to say this was the net income, the 24,400 in dollars translated from the 122,000. So we're going to be picking that up once again, not including the other comprehensive income in here. So we're going to say, all right, this is going to be the typical transaction then would be the investment in S, and we own all of the stock of S. So we're going to say, we're going to record all of the income then, therefore, and that's going to be the 24,400. The other side going to the income from S, and that will then be, of course, the credit. Then we've got this change. It's going to be in other comprehensive income now, and we're gonna just call it what it is. We're going to say, hey, look, we used the exchange rates, the best rates we could use that we think are the most relevant, and that resulted in this translation adjustment. That translation adjustment we're going to put into other comprehensive income. So we're going to say, all right, it's going to increase like it would if it went into like normal income, kind of, right? Look, it's acting kind of like revenue over here. It's a credit. So it's going to, on the other side, on the balance sheet side, it's going to be increasing the investment in S. Investment in S is going to be increasing by, I'm going to say, negative of that 21,280 for the accumulated other comprehensive income. The other side is going to go to that accumulated other comprehensive income. Let's just type it in. Let's give this long account. I'll copy and paste it. So there it is there. So we're going to record that. Again, other comprehensive income translation adjustment being the credit, then increasing the investment in S side of things. Okay, now to finish the rest of these up, we're gonna have to think about our deferral and the deferral application or allocation. So let's take a look at that down here. We're gonna go to the deferral, considering the purchase we had compared to the book value of the subsidiary. So we, the parent, purchasing the subsidiary, the amount that we spent versus the book value, that's being the differential, allocating that to the applicable components, in our case being property, plant, and equipment, and an intangible asset of the patent. So we're going to say, all right, we had an investment cost. So the investment cost, I'm going to put in the outer column. We paid then the 155. So that's straightforward. It's in cash. We're going to put that in the outer column. We paid 155. Then we're going to be taking a look at the book value of the net assets. We're going to have book value of the net assets, which we're going to have to consider because we were given the book value, of course. We're assuming we're taking this from the subsidiary's financials, which are in the foreign currency, and we're going to have to translate it then. So we're going to say, all right, here's the net assets in the foreign currency. Let's pull that into the middle column. That was the 700,000 in the foreign currency. So then we'll use the exchange rate at that point in time, at the point in time that the purchase took place. So at the point in time the purchase took place, the exchange rate, because that was on 11x4, so the exchange rate is going to be equal to what it was on 11x4, which is 0.18. So that'll give us then the book value of the net assets. So we're going to say, all right, then the book value of the net assets in terms of dollars is going to be equal to the 700,000 times the rate of the 0.18, giving us the 126,000. So now we can see the differential because we have our same measuring tool, dollars to dollars. This is going to be equal to the 155,000 minus the 126,000. There's our differential, the 29,000. We're going to apply that out as was given to the fact that the property, plant, and equipment had a fair value that was higher than the book value by it said up here, $20,000. So that's in dollars. So we don't have to do any adjustments there. So we're going to say, all right, that's in dollars. We're going to say this is going to be then. So part of that differential will be the 20,000 for the property, plant, and equipment. And then the rest we said was going to go to a patent, is what they gave us, and the remainder of the differential is going to the patent. So we're going to say, all right, so of the 29,000, 20,000 went to the property, plant, and equipment. Therefore, the remainder, or 9,000, going to the intangible asset, the patent. Okay, so then we're going to take a look at the differential depreciation and amortization. So let's look at that. So we're going to be considering then the foreign currency, the rate that we're going to be using to convert, and then the dollar. We're going to be looking at the differential, which we're breaking out to these two components. So we're basically looking at these two components of the 29,000 differential that we'll be considering here. So I'm going to make that yellow. Let's take a look at the property, plant, and equipment first, or the depreciable assets. So we're going to say then we'll take the income statement components. We'll put that up top, income statement components, and we're going to take the differential at the beginning of the year. The differential at the beginning of the year we said was $20,000. So we have it in terms of dollars. So I'm going to say that's the $20,000 was that differential. Then we're going to take the exchange rate, which is at the beginning of the years, which is going to be this 0.18. So I'm going to take that exchange rate, and I'm going to use that to back into the foreign currency by dividing out. So I'm going to take that 20,000 divided by the 0.18 to give us the foreign currency equivalent at that date, at that point, at that exchange rate, which is 101,111. Then we're going to have depreciation on this. So we're going to record the depreciation for the time period. We said the useful life was 10 years. So we're going to have that differential amount times the depreciation. I'm going to do that in the foreign currency here. So I'm going to be taking that 111 because it's the foreign currency books, right? I'm going to take it using the foreign currency, depreciation as if they had the differential applied in the foreign currency, and then divided by the 10 years. 10 years was it? And so there we have the 11,111. And notice there could be some rounding adjustments here, so just be aware of rounding. All right, and then we're going to multiply that times the rate now, but not the rate at the beginning of the year, but now using the average rate, because we're talking about an income statement type of account, which has a beginning and an end, or has a time frame, starts, from January to December, so we're picking up the 0.2, and then if we multiply that out, we're going to pick up the 11, and then times the 0.2, there's going to be our 2,222. Now I'm going to make that a negative for the depreciation, so I'm going to make this a negative by just putting a negative sign before the first item, and that'll plot it out so we could sum it up, and it'll subtract them, so we'll use the sum formula. So the remaining balance then of the balance sheet amount, so this was the amount on the balance sheet amount here, let's indent that one more time, minus the depreciation is going to basically leave us with the differential that's still remaining that's been applied to the depreciable assets. Let's sum this up, and that's going to subtract it out. So we have that 100 there, summing this up, we get the 17,778. Okay, so now let's consider, we're going to go to the balance sheet, and now we want to think about the remainder on the balance sheet. Now the remainder on the balance sheet, we said here, if we look at the foreign currency, is that 100,000, the differential that's remaining from the property, plants, and equipment that was over the book value at that point in time that we're going to have to add in foreign currency minus the depreciation in foreign currency, meaning we still have the 100,000 of the fixed asset in foreign currency. The fixed asset component should be on the books in terms of the end date, the current date at the end of the time period. That's the exchange rate that we should be using, and that exchange rate is the 12/31/04 exchange rate, which is the 0.21. So if we multiply that out, now we got the 100,000 times the 0.21, and that's going to result in, of course, this differential, considering we've used these different rates here. So we're going to have this differential that we're going to have to be putting into place. I'm going to call that differential, let's put that here, differential to the other comprehensive income. This is the translation adjustment. So it's going to be I'm going to make it a positive number by saying it's going to be the 21,000 minus the 17,778. So we'll do a similar process with the patent now. So we'll do a similar process with the patent, which we're going to have to amortize. So it's going to be similar to like the depreciation. Income statement accounts, we're going to have the differential at the beginning. So we'll pick up the differential at the beginning, which we have in terms of dollars of the 9,000. So I'm going to say, all right, it's the 9,000. And then I'm going to back that into the foreign currency by using the exchange rate at the beginning of the time period, which is going to be that 0.18. So I'm going to divide this out. I'm going to say the 9,000 divided by the 0.18, and that's going to be the 50,000. Then we're going to be picking up the amortization now that we have it in the foreign currency, because remember, we should be kind of thinking of the amortization of this in foreign currency units, because this is the subsidiary's books, which has the foreign currency as the functional currency. So now we're going to take that 50,000 divided by the useful life, which we said was 5 years. So we have the 10,000. Now we're going to convert that 10,000 back to the US dollars, but we're going to be using the income statement rate, which is the average rate that we're supposed to use there. So we're going to use the average rate of the 0.2, multiplying this back out. So now we got the 10,000 times the 0.2. That gives us the 2,000. I'm going to make it negative again by simply flipping the sign. I'm going to double click on this item, flip the sign here, make it a negative, just so you could sum it up and it'll subtract them. So then we're going to get the remaining balance then. The remaining balance, basically balance sheet balance, that's going to be on the books in foreign units then is going to be the sum of these, or 40,000. And then in dollars, if we sum this up, it's going to be the 7,000. So then if we think about the balance sheet side of things, we're going to say, all right, let me think about this in terms of the balance sheet side of things. We've got the remaining balance, the remaining balance on 12/31/X4 translation at year end is going to be the 40,000, right? We've got this 40,000. Then we're going to use the exchange rate on the balance sheet that we're supposed to use, which is the ending exchange rate as of that point in time, because this is the amount that remains on the balance sheet of the differential that's still there at the end of the time period. So then we're going to use the 12/31/X4, which is that 21.21 exchange rate. So if we take that 40,000 times the 0.21, we get the 8,400. So then we have the differential to the comprehensive income adjustment here, which is going to be equal to the 3,222 plus the 8,004, or I'm sorry, this should be equal to the 8,400 minus the 7,000, because again, we use the different rates up here than the rate down here to calculate this. So we're going to have that differential that's going to be a result. So we have these two differential for our adjustments. We have these two adjustments, translations adjustments, due to the differential in the book versus the investment that we put in place that was allocated then to the depreciable assets and the patent or the intangible asset. Now let's go back up top and continue on with some of our journal entries that we left off top with the equity method transaction for P recording its investment in S. Because now we have some of this information, including the depreciation calculations here and the amortization calculation that we can be adding. So let's add those items. Now you can do this in one journal entry, or you can break it out into two journal entries. I like to do it with two journal entries just to break out. We're looking at this differential now that we allocated out between the property, plant, and equipment that was over the book value, fair value over the book value at the time of purchase, and the patent that we've now calculated in the worksheet down below. So this will basically be decreasing the income from S. The other side is going to go to the investment in S. So the investment asset's going to go down, and so will the so will the income from S. So this is going to be equal to, and we're going to have to pick this up down below. That's going to be the 22, let's put a negative to flip the sign, this item here that we calculated. Notice that's different. There's a different calculation if we pull out the trusty calculator here. Pull out the trusty calculator. We're not just taking, then you might look at this and say that we had the difference up top of the 20,000 here. You might just be tempted to take the 20,000 divided by the 10, and you'd get the 2,000 not the same. Why? Because notice what we did here. We put the 20,000 on, then we converted it to the foreign currency so that we can calculate the depreciation, the 10 years into the foreign currency, right? And then we use the rate that needed to be used for the conversion, which is the average rate. So that's why it's going to come out a little bit differently. That's why you need your table down below for this foreign currency basically exchange. It's not as easy as it was, as it should be kind of. So then that's going to be the debit and the credit, and the same thing is going to be with the amortization. So same transaction, same journal entry, but now we're just going to pick up the calculation we did down below for the amortization. This one is the 2,000, but again, we did that double kind of method here. In the same method, we applied the same method to do it. You may be tempted to just take this 9,000 differential. So you're going to take the 9,000 differential and say divided by 5 years and think that should be it, but it's not. Why? Because we had to take the dollars that they gave us in dollars, convert it back to the foreign currency, then divide by the number of years, then use the proper exchange rate, which is the average rate, because we're talking about the income statement, and that's what we're going to use. All right, so there's the debit, and then the credit, and then we're going to be dealing with this adjustment that we have, which is the differentials, the difference in the other comprehensive incomes, the translation adjustment here and here. So we're going to put that in place. So that's going to be then a debit to the investment in S, and a credit to other comprehensive income. I'm just going to pick both of them up. I'm going to say that's going to be the translation adjustment of the 3222 and the translation adjustment of the 1400. That's going to be our 4622 for the debit and the 4622 for the credit. Okay, so the next worksheet we're going to take a look at is going to be the consolidated comprehensive income. So we got this comprehensive income we have to deal with now, of course. So let's take a look at the consolidated comprehensive income. So we're going to start off with the income from P. This is going to be the parent company operations, not including S. And that's given to us in the data. So P, parent company's net income, not including S, is going to be given at the $255,000 in dollars. So this is going to be in dollars. We're just going to pick up the 255. That's going to be our starting point. Then we're going to take the income from S. So the income from S that we've got in our trial balance that we worked out over here. So here is our trial balance. We got the income down below. Notice it's not including the comprehensive income. So we're just including the revenue and the expenses, not the adjustment at this point. So there's the 24,000. I'm just going to pick that up. I'm going to flip the sign. That's revenue, not an expense. I'm going to say negative of that 24,400. There's the net income from S. Then I'm going to subtract the adjustment for the differential. So we have the adjustment for the differential that we needed to put in place. And that then is going to be the depreciation adjustment and the amortization adjustment. So I'm just going to pick those two items up at once. I'm going to say this is going to be equal to the 2222, and plus the 2000. And that's going to be the 4,200. That'll give us P's net income. Therefore, P's net income will be this plus this minus this, which we can do with the sum formula, considering the negative number, equals the sum of the 255 plus the 24,4, the 4,222. That's going to give us the 275,178. Then we have the translation adjustment. So then we're going to put into place, here is our translation adjustment. Now I'm going to pick these up from the journal entries we did up top. So the translation adjustment we had here and the translation adjustment we had here. This translation adjustment was calculated from the translation on our trial balance that we had in place. This translation adjustment we picked up then from our worksheets down below. So now I'm just going to pick them up from the journal entries up top. I'm going to basically add them together up top. So we're going to say, all right, this is going to be then the translation adjustment. And I'm going to make that here. This is going to be equal to, we're going to pick up then this 21,280 plus the 4,622. And that's going to be the 25,902. And that's going to give us then P's consolidated comprehensive income. P's consolidated comprehensive income will then be the sum of the two items above equals the sum of the 275,178 and the 25,902 for the 30180. Now let's consider P consolidated stockholder equity. So P's consolidated stockholders equity, we're going to start off with P's equity balance at the beginning. And that's going to be given to us over on the left-hand side at the 3,600,000. So I'm going to pick that on the far right. I'm just going to say this is going to be equal to what was given to us, the 3,600,000 at the beginning. Then we're going to add to it the net income. Let's say we're going to add the net income here, which was the 275. So P's net income, and that's going to be equal to P's net income, the 275, and then we're going to say less dividends, which once again, this is P's books, parent, so they're going to have to give us the dividends. So dividends up top with 160,000. We'll subtract that out. I'm going to put that in here with a negative number by saying negative of then pick up that 160,000, and that's going to give us, and then we're going to have the accumulated other comprehensive income, which is going to be the foreign currency translation adjustment. Foreign currency translation adjustment, which is that 25,902. This is going to be equal to the 25,902, giving us the consolidated stockholders' equity at the end, which will be the sum of these items, which of course will be this number plus this number minus that number plus the 25,902 for a total of $3,741,080.